there's really no such thing as a risk-free investment.
No.
You hear that term a lot, especially when you're thinking about treasuries and so forth. What's the risk-free rate? There's no such thing as a risk-free investment, and it doesn't take long. I mean, we've spent 20 minutes talking about a handful, and there's more that and for every client that we see, their risk tolerance is different. It's not just market risk that we're talking about.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters here with Eli Freeman.
Excited to be here.
And Lee Mackey.
Good morning.
Today we're going to talk about the fun topic, exciting topic of risk. Thought this was appropriate. Everything going on in the world right now.
Mm-hmm.
The market's been all over the place. If you go back over the last couple of months, bunch of big days up, both up and down. Interest rate conversations over the last several years and how that affects your investing and your investing decisions. So just wanted to talk about kind of defining risk. How should you look at that, from an investment standpoint? What should you be aware of? Because I think most people, or a lot of people, when they think risk, they immediately think of like equities or stocks, and they think of just market risk, like the market going down. But there's a lot of other types of risk that are out there that can have a very dramatic impact on your investment outcomes and how you're going to perform over time.
And I know today we're going to be focused primarily on financial planning, the stock type of risks that are associated. But when you start to broaden out that spectrum of risk, risk can be incredibly personal.
Yeah,
sure.
Risks lie in not having family that lives close enough to help in time. Like risks can span much more than just finances. But today we're not talking about those type of risks.
Right. Yeah, and I've said for as long as I can remember, I've told clients, I don't believe in any, there's no such thing as risk-free. It's what risk is there relative to whatever investment opportunity you're looking at, and then discerning like what risk are you comfortable with. You're never completely running from risk. It's just you're picking, hey, I'm more comfortable taking on inflation risk versus market risk, right? And that's what you might do if like, hey, I want to leave money in cash versus invest in the market. You still have risk. It's just not in that traditional sense of, related to the market specifically. So I'm going to run down through here kind of the main core, kind of areas that risk are involved when it comes to investing, and we'll kind of touch on each one. So the first and most common one that people think about or, is most often used is just market risk. So this is risk that your investment value will decline based on broad market conditions, such as economic downturns, geopolitical events. So this is just exposure that you have to public markets. I guess you could say even private markets, even though that you may not see that in real time. But based on the general economic outlook and conditions that are going on. So just jump in if you have.
Yeah, that's your standard.
Yeah, that's the most common
risk. So that's whenever people talk about risk, they're almost always talking about downside risk.
Correct.
I'm willing and able to accept something like a 10% downturn or
related to
20%
the market.
Downturn. Now financial companies have become so good at knowing people are willing and able to accept certain levels of risk and want certainty and guarantee around that we have a multitude of products that have been developed. Sure. And just in the last few years, buffered ETFs have become a massive product.
Like the defined outcome ETF.
Defined buffer. And that's a type of risk. But really, when you start to think about risks that you don't have control over, that's one of the few that we start to have a little bit more control over than some of the other ones.
Yeah, it's just what are you having to give up to define that?
Yes.
When I think of risk, and you're going to get into many, it's almost like the old game of whack-a-mole that you want to alleviate or eliminate one risk, and so you hit it, well then pops up another one, and then you go after that one and another one, and it's like you're never going to eliminate all risk. It's just a matter of which ones do you want to focus on. Anyway, when y'all were talking, I had that.
No, it's a good analogy. So you've got market risk, then you've got interest rate risk. So this is something that we've seen, recently over the last few years with interest rates just moving a lot more than they had for many, many years. This is risk that arises from changes in interest rates, particularly related to fixed income securities like bonds. So, for those of you that don't know, or a reminder for those of you that may know this already, interest rates and prices are inversely correlated, right? When it comes to fixed income instruments. So as rates go up, the value of, a bond or fixed income position that you already own is going to go down because it, you can go buy a new issue, right, with a higher rate. So why would someone want to buy your bond that had a lower rate from a previous date? So there's risk relative to, as interest rates are moving, how is that affecting the value of those positions that you may already own?
Well, and I think too, a way that oftentimes we feel like interest rate risk affects the fixed income markets, the bond markets, but we've seen as rates go up, it affects the equity markets because now clients or investors can go to the bond markets to get a higher yield, if you will. And what do? They sell their equities, forcing the equity markets to go down. So, as a general rule, as rates are rising, oftentimes the stock market is falling because of that exodus of money from one to another.
Yeah, as rates continue to stay elevated, the risk premium for stocks diminishes.
Sure.
People don't want to take risk to get 7% returns when they can go get 5.
Yeah.
And there's a lot of truth in that,
Sure.
and we've seen that just in the last little bit. But I think even more so on interest rates, there's the risk to fixed income. There's the risk to equities taking some pressure because of rising interest rates. But you can spread that out to now it's harder for companies to grow because now to go get debt, it's more expensive. It's harder for consumers that are on the low end with credit card debt, having to take out large auto loans at high interest rates. High interest rates have a broadening effect out in many different capacities to the upper echelons of net worth to the
Sure.
low echelons of net worth.
Well, and on your debt topic, it hurts the small companies. We were talking about consumers, but it hurts small companies the most because oftentimes your mega cap, large cap companies have sufficient cash. Well, they can weather that interest rate storm and because they have cash on hand. But, your mom and pops, your small publicly traded companies need to go out and borrow. And oftentimes they have variable rates that go sky high during rising interest rates.
I mean, you don't have to go far now with rates where they are to go find a 12% yielding bond fund because it's companies that need cash. Banks won't lend it to them because they're trying to grow so quickly. So they go out to the private markets and they'll lend them out at these rates of 12 to 25%.
Well, I was going to say 10 to 12%. It's like all over the place.
Yeah, it's all over the place.
Okay, then you've got credit risk, which is just the risk that refers to the possibility of losing money if the borrower defaults on its debt obligation. So we're talking about companies needing to go borrow to grow, to build their business, and right, credit risk is just that business isn't able to pay its obligations, isn't able to pay off that debt. So that's pretty straightforward. Inflation risk. So inflation reduces the purchasing power of money over time, meaning the value of an investment may not keep pace with rising prices. And this is one that we've talked to a lot of people about, and it's been more relevant in the last few years because inflation has actually been, around and a real thing. But, I think people think of cash as that risk-free, asset. And I've talked to clients for years about it's not, you're just accepting that you're more comfortable with, your purchasing power being diminished and taking on that inflation risk than you are maybe dealing with the volatility that might, be in play with, publicly traded instruments. And so that's a big deal now, and it gets harder when inflation is at 2, 3, 4, 5% versus 1.5. Taking inflation risk at 1.5 is maybe easier to accept. But if we're clipping off 3 or 4% a year for inflation, it doesn't take too long before you look up and you're like, man, I need to put this money to work and at least try to keep up with that or offset that.
Here's a perfect example. April of 2020, if you put $100,000 into the stock market, you have averaged a 16.59% return till April of 2025. After inflation, so if you take that inflation out, 11.75. That's a difference of $218,000 to $175,000.
Mm-hmm.
Just in 5 years, you can see
In real dollars.
in real dollars the difference in inflation.
Yeah.
Liquidity risk. So this refers to the difficulty of quickly selling an investment at a fair price. So, yeah, I mean, there's all kinds of liquidity concerns and things that you need to be aware of. I think oftentimes we take for granted the abundance of liquidity in our public markets, right? That is typically there when we need it and expect it. But I think we take that for granted, that that's just an expectation, and that something that we're thankful for. But you got to remember, every time you want to sell something, there's got to be a buyer on the other side, right? And there's market makers out there, and there's different people that are in place to try to help ensure that. But that's not a contractual guarantee. When
Correct.
you buy a position, it's not like there's a guarantee that comes along with that like, hey, when you want out of this, we're guaranteeing that someone's going to be on the other side of that transaction. There are other vehicles, other investments, some of which we use, some of which we don't. But, insurance products that might have really strict liquidity restrictions, others that might be a little bit more flexible. There's things like REITs that we've seen over the years that can be incredibly difficult to get out of, at various times. There's publicly traded REITs that can be pretty liquid. And so you just don't want to go into it blind. You want to know what you're getting into. Like anything, you probably don't want to have all of your money in one place. And so liquidity risk is something that you definitely want to be aware of. And even if this investment vehicle is giving you a lot of great options and great features that maybe you can't get elsewhere, you want to be aware, like, am I taking too much liquidity risk, and am I giving myself access to enough capital when I'm going to need it?
I was listening to an interview yesterday with Bill Ackman. He's the CEO and founder of Pershing Square, the private equity firm. Big Harvard supporter, Harvard graduate, and of course Harvard's been in the news lately in their fights with the administration. And he has come on the side of Harvard needs to change a lot of its practices and so forth. But they were talking about the endowment, and he was saying that Harvard's endowment is estimated $50 to $60 billion. But he made the comment yesterday, to your point about this liquidity, that probably 70% of their endowment is in illiquid assets, private equity and or real estate. And he said that if they are, and right now they're going through somewhat of a financial crunch, and he said in order to raise, if they needed, $10 billion, it would not bring what they have valued it at. Yeah. I mean, and so...
Well, actually, about a year ago, I read the portfolio manager for Harvard, who managed their endowment for about 30 years. And what he talked about was the difference between an endowment manager and the school's objectives, and how the endowment manager has to tell them what they can and cannot use from the endowment, because it's not structured for large liquidity events.
Correct.
And that's going back to exactly what you're saying is how you structure your investments in your portfolio have to match up with what your surprise liquidity events can be.
Yeah. And often you should be, if you are giving up liquidity when you're putting capital to work, you should be getting something in return, right? That either needs to come in the form of, the potential for higher returns. It needs to come in maybe the potential of more
income stream.
Better income stream or more downside protection. Mm-hmm. Like, you should always be, getting something in return for giving something up. And so you wouldn't want to make an investment that you're giving up liquidity, but it's giving you all of the exact same benefits that you could get with something that's fully liquid.
Sure.
Right? That wouldn't make sense generally. So, but it's something that can make a lot of sense. It can make perfect sense to say, yeah, I'm willing to give up a little bit of liquidity on a portion of my portfolio because this vehicle can do things that the rest of my portfolio can't.
Yeah.
Correct.
Right?
Perfect example is when people invest privately in real estate.
Yeah.
I'm willing and able to give up a portion of my portfolio for the purpose, typically for retiree primary purpose of income. Well, all you have is that income, unless you take a loan out against the property, but then you have to pay the loan off.
Yeah.
So,
then you're reintroducing all the other risks.
Then there's new risks.
Correct.
Yeah. Currency risk. This applies to investments denominated in currency other than the investor's home currency, and can introduce fluctuations in exchange rates. So movement in currency valuations. We've seen a lot of pressure on the dollar lately. So that's a big deal when you're looking at, investments outside of your home country.
Yeah, that typically doesn't apply much to retail investors, but you'll see that on the institutional side, really large corporations, that one of the 4 highest levels of volatility spike happened just about 6 months ago, I believe, because of a currency trade. The yen and the U.S. dollar were flipping in valuations, and all these hedge funds had to unwind a trade. It created a massive amount of volatility in the market.
Yep. You've got business risk. So this is pretty straightforward. Just risk associated with the specific company or industry that you're investing in. So if you've got a lot of concentration in one particular business, there's just risk that, maybe the economy and the markets are doing well as a whole, but that particular business is under a lot of pressure. Systematic risk. So this is one that you'll hear, we hear a lot about in our world, unsystematic and systematic risk. Systematic risk is risk that affects the entire market. So this is something that's broad. It leads to kind of an overall economic downturn. Like, it doesn't matter if you're invested in staples or technology. It's like you're just exposed to the market and the market's down.
And the way I learned about it is it's undiversifiable, meaning it doesn't matter where you're in. COVID's a great example. For the most part, I mean, yes, there were pockets that did well. But COVID was one of those undiversifiable risks.
There was a 3 or 4 week period. Everything was just
everything went down versus the other type,
unsystematic risk,
where you can, it's avoidable.
Right. Unsystematic risk is risk specific to a company or business or industry that you can diversify away from. So this is like, hey, we don't want to have everything in, technology or communication services.
Up here we see it, with so many Walmart,
retail
JB Hunt,
kind of oriented,
yes, and so a large position in Walmart could be is a business risk as well as a unsystematic risk. I mean, it is diversifiable.
If you want to read a compelling book that talks about systematic risk, no, it wasn't designed to, but there's a diary that was kept by a lawyer in New York named Benjamin Roth. He lived through the Great Depression, and he diaried what was happening, the emotions, the news, what was happening through the Great Depression. That is systematic risk.
Yes.
And there's not a place that you could have hid that kept you from the systematic risk that was happening during the Great Depression.
Yeah.
And you use the word hide. And I think during periods of the markets that it just seems like everything is going down, I've used that word. There's nowhere to hide. Bond markets are getting sold off. Equity markets, cash. I mean, it's just across the board. We're throwing the baby out with the bathwater.
In that instance, there was a lack of liquidity at the banks and financial institutions. I mean, it is everything that we're talking about.
Yeah.
Cumulative.
Man, I feel like I'm back in college.
I know. It's like investing.
Finance.
101.
Exactly. Exactly.
Reinvestment risk. So this is, you've put capital to work. It's invested for a period of time. Maybe it's in something that has like a maturity date associated with it, like a bond. A CD is a great example. A lot of people have been, hey, I can put money in a CD for the first time in years because they're paying pretty decent. Well, there's reinvestment risk associated with that because what are you going to do when that becomes due? You're kind of pigeonholed into, okay, now you've got to make a decision at this date to do something else with it because it matures at a specific period of time and you don't have a lot of flexibility around, some maybe depending on what the instrument is, but reinvestment risk of, this is often why you'll see us or other investment advisors. It's one of the reasons, not the only reason, but you might build like kind of a ladder, right? Mm-hmm. You kind of try to manage your reinvestment risk so that not everything is coming due and maturing at the exact same time, right? And so you build in, hey, we don't know what rates are going to be, or we don't know what X, Y, Z is going to be in 3, 5, 10 years. So let's not expose ourselves to having to make a decision on our entire portfolio at that one point in time. And so, there's ways that you can diversify and try to manage that risk, but reinvestment risk is a very, very real thing.
Yeah.
Another way that we see reinvestment risk comes with people who are doing private transactions with real estate companies. So taking a couple $100,000, giving it to this real estate company to manage it. Typically that's on like a 5 to 10 year payback schedule, and they're going to sell the property or refinance out. And when they do, they don't get to choose when that happens.
Right.
And they have no control over that. And then they have to go do something else.
And then you got to put it back to work.
Yes. Right.
Right.
Yeah.
Horizon risk. So this is, time horizon risk, just associated with what is your time horizon for those particular dollars or for your particular situation. It's something super important. We often talk to clients, hey, if your time horizon is not at the bare minimum a few years, like you probably don't even need to be looking at, equities in public markets, because depending on what you're investing in, you have to give it the time to work and do what it is kind of designed to do. And so if, so something that you have to be.
Well, and it's also, life happens.
Yeah. The
I've got
unexpected
a 20-year, I don't need this money for, 20 years. And then all of a sudden something catastrophic happens in year 7. That is a seismic shift in the horizon.
So y'all probably heard me talk about, the listeners have probably heard me mention like the retirement red zone, but it's something I talk to clients about, and it's the 5 years before retirement and the 5 years after. It's kind of that 10-year, I know the red zone's 20 yards, but just bear with me. But it's that 10-year window, 5 years before and 5 years after retirement, that from a time horizon perspective, you're right on the cusp of starting to need income and generating income from your investments. Your time horizon from a retirement perspective is the longest it's ever going to be, right? Because you're right at the beginning of retirement. And so we often talk through clients of like, hey, if you're ever going to be a little bit more cautious, not saying you need to be overly cautious, but that kind of red zone period is a great time to just make sure we don't experience any kind of catastrophic events, or we manage through that the best we can, because the numbers show that like the later you get in retirement, actually the more aggressive you can afford to be, because your time horizon is shorter.
Yeah.
It's not how most people think, but that is horizon risk, right?
Yeah.
You can deal with more volatility because you're not now only trying to fund 10 years of retirement versus 25. So thoughts?
My favorite example, little cheesy, so bear with me, is to think of your dollar bills as an army, and you've got your short range and you've got your long range, and you have to think of that. We've got our short range that's ready and able just to march forward. Then we've got some that are archers sitting in the back shooting long range. That sounded so much more cheesy when I said it out loud.
Yeah, no, it's okay. It works.
It actually sounded cheesy and
That was brutal.
I'm picturing all my as a little kid, my little plastic army men.
Pull them out.
Yes, yeah.
And then this is the last one I've got, and then we can talk about anything you guys have on risk. But concentration risk, Lee mentioned it a minute ago. With people that around here, right, with your large corporate corporations that we have around here, people are getting a bunch of stock options, RSUs, and these things, and you can potentially have a lot of concentration risk where you just have a lot of your money in the same bucket, whether it's, hey, I've got all my money in cash, right? That's still concentration risk, because now you're fully exposed to inflation risk and some of these things that we talk to, or hey, I have all my money in annuity. Well, it's not a bad thing necessarily, but you're taking a lot more liquidity risk potentially, depending on the structure of that. Or I have all my money in Walmart stock, right? So this is not unique to any one thing. It can be applied across kind of all different investment vehicles and opportunities, but this is where you want to get into, the conversation of diversification. How do we diversify away from some of these things and make sure we're not overly concentrated, whether it's to a particular company or any one particular type of risk?
You know what I think is interesting? Excuse me. There's really no such thing as a risk-free investment.
No.
You hear that term a lot, especially when you're thinking about treasuries and so forth. What's the risk-free rate? There's no such thing as a risk-free investment, and it doesn't take long. I mean, we've spent 20 minutes talking about a handful, and there's more that and for every client that we see, their risk tolerance is different. It's not just market risk that we're talking about. It's where they are in their time horizon, and what are their other investments that are held outside of ones that we manage, and so we cannot fully diversify away from everything. Even the proverbial putting the money under the mattress or burying it in the backyard. Yeah, there's risk to that.
Sure. Eli.
Yep. I was doing some research. I have something else to talk about, but I was doing a little bit of research before doing it.
I think that kind of the takeaway for me, and hopefully for listeners out there, is that to your point, Lee, there's no way to completely avoid or run from risk, totally.
Mm-hmm.
So it's being honest with yourself. What kind of risk am I comfortable with?
Mm-hmm.
How do I need to diversify to be exposed to knowing? It really starts with accepting I can't avoid risk completely, because then you say, okay, what am I comfortable with? How do I need to diversify so that I am more exposed to risk that I'm comfortable with, and I'm avoiding more of the risk that I'm not comfortable with. I'm not overly concentrated. I have the liquidity I need, and this is why you want to have multiple buckets of money in different places, doing different things for you, because if anyone ever looks at you in the eye and says, hey, this is gonna do everything you need at all times, right? And it's like one it's just not true, right?
So where I was researching whenever
quick little 30-second research.
Quick little 30-second research. What I was trying to find, because I did a data brief video over this, so maybe we can link this in the bio, is the difference in returns for individual investors versus the stock market. And this is a risk that I don't think we talk about as often, but it's all of the psychological risks of investing. Mm-hmm. And those are just as important as all of the systematic and unsystematic risks that we talked about. So I want to go through just a couple of them. The difference between the stock market and retail investors is massive. Stock markets average 10%. Retails are like 3%.
Yeah.
It's something horrible. And all of it comes back to the psychological part of it. So loss aversion, being too scared to lose, not taking good investments because you're too scared to lose. Overconfidence, thinking you know more than you do. I think we're all guilty of that. Herd mentality, seeing things on the news, following them. Recency bias, thinking that what worked will work and will always work. Anchoring, sticking to the plan because you think you have to. If something's down, I'll hold on to get it to the top. If something's worked, it's going to continue to work. Confirmation bias, only listening to news sources and media that confirms what you believe. FOMO, regret aversion, mental accounting, which is a big one. And that's about all of them.
I think you just described all of the problems that in America we're experiencing right now. No, those are even, I think, in a lot of like all the risks that I went through were kind of your standard investing 101, like textbook. Like this is what you learn about, what we all learned about, back in the very first finance courses that we took. Those are the more kind of real world personal risks that you have to be aware of, on the personal side, and like have the accountability partner, because you're having to check yourself. These risks are almost, I would say, easier to deal with because they're known.
Sure.
You diversify away from them. Those are the ones that you can do all the appropriate things here, but if you still let yourself get in the way, then like none of this is going to matter, right? Yeah. Because if you're doing dumb stuff at the wrong time, or then
that's where I think it matters to have someone else doing it with you. Whether that's a friend that you do investing with and you can hold each other accountable, or an advisor, or a mentor,
100%.
someone that's checking you.
And we say often, we try to take the emotion out. Everything you mentioned there, the psychology, it evokes an emotion, good or bad. And good financial advisors will take a lot of the emotion out of this game.
And one of maybe not the most common examples, but something that I see often is people thinking that like, okay, this stock was trading for this, and so now it's down, and I'm just gonna wait until it gets back to that to sell, right? It's like, well, how do you know like it should have ever been trading for that to begin with? Yeah. Right? Like and there's just so many, we could talk for hours about all the different scenarios of getting in your own way, making poor decisions. Your expectations are out of whack because of what was true, and you expect it to be true again. And it's interesting. It's a big deal. And I think, educating yourself, listening to podcasts, reading books, having the accountability partner, the advisor that you can kind of bounce ideas off of back and forth is super, super valuable. And, just having the humility to, like you said, like over confidence, right?
Yeah.
having the humility to be like, you know what, I don't know near as much as I think I know, but like collectively, that's kind of why we do things the way we do things here as a team. Because like not one of us knows near as much as we might like to think or think we know. But when we get in a room, there's 8 or 9 of us advisors and we're brainstorming and picking, like, you know, there's a pretty smart room. I'd like to think.
Hopefully.
Right? Collectively. So
Our clients hope so.
yeah, a lot of value in that for sure.
Yes, very much.
So
very much.
not the most maybe fun, exciting topic today, but I think super important. Go out there, just Google these or Chat GPT or whatever. Is that what you
Yeah.
said?
Oh, yeah. That's what I do.
Chat it.
Gemini.
And you know, read up on these kinds of risks, you know, when it comes to investing and stuff. Be aware of them, know what they are, know what you're comfortable with, and make sure you're invested appropriately.
Yep.
So as always, we appreciate you guys listening, watching. Give us a like, subscribe, comment. We appreciate you guys being here with us every week, and we look forward to seeing you next week. Thanks, guys.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.